Hello, everybody. Hey, Ryan. Hi, Malachi. Hi, Paul. Um, Hopefully, everyone's had a chance to. If you didn't get a chance to be live yesterday, hopefully you got a chance to review it after the fact. So that was a shorter one than it's going to be typical. Hey, Samantha. Hi, Jason. Hi, Kelly. Um, the other thing too, just to be aware, as I just sent out an email. I've formed groups, study groups, and so I did that within the Canvas platform. And so you should be able to be in contact with each other through that platform, and you can actually collaborate within it as well. Of course, you don't have to use it; it's just available for you to use. If you wanted to be part of a group and somehow I didn't assign you to a group, please let me know and I can make that change. Also, if you're having trouble getting into contact with group members or if somehow the platform isn't working properly, also please let me know and then I can try to fix the problem. It's my first semester using groups this way, and so there may be something that I missed. So I just wanted you to be aware of it. Other than that, hey Harry, I think it's time to kind of jump into non-current liabilities because this one's a little longer than the previous one, so I want to make sure we kind of get moving here. So the first thing we're going to talk about is bonds. And so obviously with non-current liabilities, if you kind of have read through chapter 14, bonds are kind of the lion's share of the chapter, and so we'll spend a lot of time there, and then of course we'll finish up with notes payable as well. So basically, if you want to think about a bond issuance, it's really a contract between the bond issuer and bondholders. And so the question kind of quickly arises when we think about a contract is, in what way is this a contract? And I think the ones that are kind of obvious is, there's an agreement on the length of time and frequency of interest payments that are part of the bond. There's the amount of the interest payments that's also part of the contract. There's also a contractual agreement to pay a lump sum at the end. And then the other part of it that you might not be as aware of is there are also many times other covenants and restrictions within these contracts. And so, as an example, there may be a sinking fund where you have to, the issuer has to put money to set aside money to pay off the bond's face amount on a regular basis. There may be restrictions on paying dividends. There may be a requirement to have a certain current ratio. So there's all kinds of things that go into these contracts beyond just the interest payments and the face amount. There's kind of one of three ways that bonds get issued. One is called firm underwriting, and with firm underwriting, there's an investment bank, and they purchase the bonds from the firm, and then they sell those bonds to the market. And so basically the negotiation on the price is a negotiation between the bank and the firm, and then the bank go ahead after they purchase them from the firm, and then they'll go sell them to the market. And with this particular arrangement, the investment bank has a lot of risk, and so the firm probably is not going to get, they're probably going to have to pay more interest on the bonds in order to issue it this way because the bank wants to be compensated for its risk. The second kind is called best efforts underwriting. And with best efforts underwriting, the investment bank facilitates the bond, but they actually don't ever take ownership. And so they're the ones that they're going to charge a commission on the proceeds, but they themselves will never purchase those bonds. And so with best efforts, the firm has a lot more risk. But of course, if they take on more risk, it's likely that they're going to pay less in interest. And so just be aware of that. So those are kind of the two major ones. There is another one that's called private placement. And with private placement, the issuing firm basically circumvents the investment bank and instead issues the bonds directly to the market. And so in this, like a large company or even like a financial institution, they might not need an investment bank, and so they can do a private placement. Or sometimes there may be like a large entity that wants to take the vast majority or all of those bonds, and so then they can privately place those bonds with that particular entity. Kind of the next big thing to think about is how are bonds valued. And so we're going to kind of do this kind kind of there's two things we have to be thinking about as we walk through a bond valuation, and one are the market conditions around the issuance, but also the second piece then is the contractual obligations. And those two are related, but sometimes there may be some differences. Hold on, I have a 10-year-old playing Fortnite in the background, so I have one second. Sorry about that. If any of you have kids, you know what that's like. But he's getting frustrated because, I don't know, whatever, it's Fortnite. All right, so back to bonds. And so we have market conditions versus contractual obligations. And so understand that the contractual payments are determined before the final issuance takes place. In other words, there's this pre-negotiation on what interest rate the bond is going to pay. And a lot of times, the vast 99.9% of the time, during that negotiation, the firm, the issuer, agrees to pay the market rate of interest. But just understand that that's negotiated sort of at one time, and then time's going to pass, and then there may be an issuance that's delayed. It could be months or even a year before the issuance actually takes place. And sometimes market conditions change. And so I just want you to be aware that contractual obligations are established before the issuance takes place, and if anything changes within that time, then the contractual obligation to pay interest may not quite match what the market demands. And so because they can change, one situation, of course, would be that conditions get worse. There could be, a slowing economy. There could be bad news about the company. Lots of things could happen. Basically, market conditions could get worse. If that happens, then the market demand for interest is going to go up, and so the bond then is going to be issued at a discount. At the same time, if information comes out and all of a sudden there's good news or the economy picks up or whatever, in that case, the market conditions are improving, and that means the market rate is going to go down. The market demand for interest is going to go lower, which means then the bond would be issued at a premium. Very rarely would they go back and renegotiate the interest payment, because now you have to redo the contract. And so more likely, if there's a change in market conditions, they'll just be issued at a slight discount or a slight premium. Most of the time, bonds are issued at par. I just want you to be aware of that. Most of the time, bonds are going to be issued at par. All right, let's kind of walk through the mechanics. And so, as I mentioned, we use a TVM calculator, and I use the Texas Instrument BA2 Plus, and that's this one right here. This is the professional version, which is probably a little bit different than the one you might get if you were to go to like Walmart or order it from Amazon or something like that. But all TVM calculators have the same functionality across these 5 buttons: the N, the I/Y, the PV, the payment, and the FV. So that main functionality is the same regardless of the type of calculator you might have. And so we're going to kind of walk through, in the context of bonds, how we use the financial calculator. We're not going to spend a ton of time on this, but I at least want to introduce it. So the N is the number of interest payment periods, and so it's very important that you understand this isn't the number of years. It's the number of interest payment periods. Now, the nice thing is if interest is paid annually on the bond, well, then the years and the interest payment periods are the same. The difference, though, comes is if it's like a semi-annual bond or a quarterly bond where interest payments happen more frequently. And in that case, the N would need to reflect the number of interest payments, not the number of years. The I/Y. So when we talk about the I/Y, this is the information, this is the market rate, the market information. We use a lot of different words for this notion of the market rate of interest. Bond yield is probably the one that I use the most, but also I've used, and others have used, market rate, discount rate, required rate of return is another one that I've heard. So all these things are synonymous with that I/Y button, which is basically the discount rate that's going to be applied to the cash flows. And then the PV, that is the price or the proceeds or the cash received at issuance. And so sometimes with these bond problems, you'll be given a price, and that price is what we put in for the PV. Or we might say, X number of dollars are raised with the issuance. That's going to go in for the PV. And so that's what the PV captures. And then the payment, that's the contractual interest payment. And so there's a bond rate that we apply to the face value. And so that payment is calculated by applying the bond rate to the face value of the bond. And so again, that payment is the contractual interest payment, and you need to be familiar with this idea of a bond rate, or the interest payment rate. So that's different. Notice the I/Y is bond yield, which is a discount rate, whereas down here at payment we're talking about the bond rate. And so those are slightly different things, and you need to be familiar with those differences because that's a very common terminology. And then finally, the FV is the par value, otherwise known as the face value. It's the cash amount that's going to be paid at maturity. Hopefully, you've seen bonds before, and that's not too new. But we do have this FV, this par value, that we need to include as well. All right, so let's walk through an example, and hopefully that this will allow you to get better with the buttons. And with each of these, I'm going to kind of fill in some information. With the first one, I'm going to fill in some information, and then we'll kind of go from there. And so let's kind of take the first one. So a company issues $500,000 in 6% annual 10-year bonds on January 1st, 2020. What is the bond price if the bond yield is 5%? And so, actually, you know what? Let's give it a shot here. So, on your own, with your own calculator, let's kind of talk about how we input this information. And so, as you're putting information into the calculator, you always have to think number and then the button. So, number, then the button. And so, as an example with this problem, let's start kind of filling in left to right. And so with the N, we have to think, well, how many interest payment periods are there? And so the N in this case is 10. And so you do 10, and then you hit the N button. And hopefully what you end up seeing is N equals 10. Now, one thing you might notice, I think hopefully you can see it on my screen, is that I have 4 decimal places. And so for some of you, you might not have 4 decimal places. And so really quickly, I want to kind of show you how you change that. And the way that you change that is first you start with the second button. So you go second, and then down here under the decimal place, it says format right above it. And so then you go format, and it should say DEC. Yours probably says equal 2. Mine says equal 4. If you want to change the number of decimals, you just hit the number of decimals you want. So I'm going to put 4. And then you hit the enter button at the top. And when you hit the enter button at the top, it should reset it to 4 decimal places. And if you're doing this for the first time in the chat, if it worked for you, just say got it. Or if not, say oops, what did I do wrong? And maybe we can walk through it again, but hopefully that got it for you. So we're resetting the decimal places first, and then we're going to put in the information. Again, the way, once you reset the decimal places, to put the information in, again, you do 10, and then you hit N, and now you should see N equals 10. Again, probably not doing it perfectly, but hopefully you can see it. So that's the first piece. So the N equals 10. And then remember, we're trying to solve for the price, and so we're told that the bond yield is 5%. And so the I/Y, if you remember, the I/Y is where we put in the bond yield. And so your calculator interprets whatever you put into that I/Y spot as a whole percentage. And so if I want to say 5%, I would do the number 5, and then I would hit I/Y. And it would say I/Y equals 5. It's telling it that the discount rate, or the bond rate, the bond yield is 5%. All right, and so that's how we put that in. Oops, I put the other one in. Oh, my bad. Let me kind of fill this out. All right, so the I/Y is 5. And then the next thing is the payment button. Because remember, we're solving for the price, so we're solving for PV. And so we're told here that the rate on the bond is 6%, so it's a 6% bond. And so you take, in this case, you have to figure out, well, what is 6% and what is it 6% of? Remember, it's 6%, which is the bond rate, applied to the par value. And so you take 0.06 times 500,000, and you get 30,000. So that is the contractual interest payment. Now notice though on my input there I have a negative number, and the reason why I do that is I want to think of this bond from the bond issuer's perspective, and so the interest payment is an interest payment that they are making, and so it's a negative cash flow. And so the way that you do that is at the very bottom there's a plus minus sign, and so you go plus minus, and notice that there's a negative sign now in front of the 30,000, and then you hit the payment button and it says payment equals negative 30,000. And then similarly for the 500,000, we type in 500,000, hit the plus minus to make it negative, and then hit the FV button, which gives us negative 500,000. All right. So once you have all that information in, so now your 4 of the 5 buttons are filled in. And so now we need to solve for the PV. And so the way that you do that is once you put all the information in the very upper left-hand corner is this compute button, CPT. And so then you say compute, and you hit your PV, and you should get $538,609 if we're rounding to the nearest dollar. And so that's how we do this. All right. So again, number then button when inputting in, and then compute PV for this problem because that's what we're computing. And hopefully you're all able to get that. The next one question is, what is the bond yield if the bond price is 100? Now you probably can solve this if you're following what I've said so far. You probably can solve this without any calculation. Can you go back over how you got the payment number? Sure. So Paul wants to know how we got the payment number. And so again, it's the bond rate. So you can see in that first line, the company issues $500,000 in 6% annual 10-year bonds. And so all that information lays out the contract. And so the contractual bond rate is 6%, and we apply that to the par value of 500,000. So 0.06 times 500,000 gives you 30,000. And again, hopefully that makes sense. Now, one thing I want to highlight here in this second one is that the way the bond price is quoted. So it says, what is the bond yield if the bond price is 100? When you see a bond price, that's a percentage of par. Someone had a TI-84 and I didn't get the PV. So there'd be a couple of things that might cause a problem. Number one, you may have the number of payments per year incorrect. It needs to be one payment per year. The other thing that I've seen sometimes is you have a sign flipped. Outside of that, with the TI-84, I'm not as familiar with that one, just because each person kind of, I don't know, each one of those is just a little bit different. So there could be a lot of reasons. That might be something we have to talk about on a WebEx meeting or something like that, or hopefully we can figure that out. Again, it might be your P/Y. So sometimes the default setting on those is they have a P/Y, which is periods per year. They have it set to 12, and you need to make sure that it's set to 1. So just to be clear. All right, so whenever you see that bond price as a quote, it's a percent of par. And so if you see a bond price of 100, that means that it's issued at par. Now, one thing we talked about is that if the market rate equals the bond rate, then there will be no discount and there will be no premium. And so if we kind of infer from here, what we can see is that we can see that the bond that at 100, that means it's being issued at par, which means the bond rate and the bond yield are going to be exactly equal. But just to kind of show it to ourselves, why don't we go ahead and I want you to try to solve this on your own and see if you can put all the information in and solve for the bond yield. And so you're going to have to put in the N, put in the PV, put in the payment, put in the FV, and then solve for the I/Y. So Cameron, yeah, I'm not sure what might be going on. Again, that might be a WebEx meeting, or I don't think you chose to participate in a group. Sometimes the groups can help with that kind of thing. But again, maybe we can figure it out. Again, with the TI-84, I'm not as helpful. If you had a financial calculator, I probably would be able to help you a little more quickly. Oh, Aiden. Oh, thanks. It's just, sorry, the name is pulled up differently. Got it. So you are actually in a group then. So you're just assigned a group. I'm betting your group may be able to help you. But again, if it doesn't, just let me know and we'll set up a WebEx and I'll be able to solve it for you. All right, so now that we've kind of, for those of you that aren't participating in this side conversation, which is fine, let's see if you are able to get the information. All right, so with the N, the payment, and the FV, those are obviously the same. So the contract itself hasn't changed. What has changed is the PV. So notice that in this case the price is 100, which means that you have $500,000. So the company is receiving $500,000 today for that bond, and so they're getting plus $500,000 as the PV. And so when you solve for that, you should get 6, like right on the button. You should get 6. Again, it's number then button, and then you need to solve for the I/Y. And then the final one is what is the bond yield if the bond price is 98? So again, this would be a situation where instead of the PV being 500,000, which is 100% of the par value, what if the PV were 98% of the par value? And so again, the N, the payment, and the FV are exactly the same. And hopefully then you can solve the last two pieces by putting in the information for the PV and then solving for the I/Y. So the PV is 490,000, which is 98% of 500,000. And then when you solve for the I/Y, you get 6.2753%. Again, if you're struggling with this a little bit, if you're in a group, I'm fairly sure the group is going to be able to help you, at least one person in the group. If you're not in a group, or if your group isn't able to help you, then absolutely come talk to me, and we'll set something up. Good job, Samantha. Good job, Nicole. All right, so it sounds like you guys are tracking there. Again, if we were in a classroom environment, I'd be able to kind of probably just see exactly what you're doing. Oh, sweet. Good. Glad you got it to work. All right, so hopefully now, you're not just calling me hey guy. All right. All right, let's keep moving. So bond type summary. So what we have here, if you kind of notice these three situations, the first row, the bond is being issued at a premium. The second row, the bond is being issued at par. And the last row, the bond is being issued at a discount. And so we're going to kind of take that information to kind of conclude some things about bonds and when they're issued. And so the first one is with a par bond, and this is the easy one. So whenever you have a par bond, the situation is that's where the bond rate equals the bond yield, and the par value is going to equal the price. So there's really, everything is equaled out. When you have a discount bond, that's a situation where the bond rate, which is the contractual rate, is less than the bond yield, which is the market rate. So basically they're not paying as much interest as the market demands. And so since they're underpaying the interest, that's going to be a situation where the par value for the bond is going to be more than the price that you get for the bond. And then finally with the premium bond, it's the opposite, where the bond rate is more than the bond yield. And so you're paying more interest than what the market demands. If you're paying more interest than the market demands, then the price is going to go up relative to par value. And so that's a situation where the price is more than the par value. Again, this is just sort of definitional. This is an important slide for you to understand, okay, do I have a discount bond? Do I have a premium bond? Do I have a par bond? What do I have going on here? All right, so now let's kind of walk through some journal entries with bonds that are issued at par. And this is kind of the simplest that it can get. I'm going to tell you right now on the first test, there's not a lot of calculations we're going to do where the bonds are issued at par, but we need to start somewhere. And so we have this example where a company issues $150,000 of 7%, 10-year semi-annual bonds on January 1st, 2020. And so again, all that information there gives you the contract. So we know that the lump sum at the end, or the par value of the bond, is $150,000. We know that the bond rate is 7%. The maturity is 10 years, but more importantly, it's really 20 semi-annual periods. And so, all right, so we're still allowed to use abbreviations like discount Absolutely. Now, I will say, because we've kind of transitioned to an online format, and Samantha, you may I don't know if you took tests before where you had to do a lot of fill in the blanks, where you had to, like, if I gave you like a text box and you had to type in a bunch of stuff. I'm trying to move away from that as much as I can because I think students struggled with formatting. And so I've been a little more specific in formatting the questions, so there's not as much flexibility and not as much. You're not going to have to come up with account names as much because I just think it was a waste of time. And so if there's a situation where you were to have to put in something like that, an abbreviation would be okay. But with the current format of the tests, that's going to be very limited, if there's any at all, actually. So again, we have the interest payment dates, June 30th and December 31st, and so let's walk through the journal entries for 2020. The first one is, of course, the issuance. And so the issuance is at par. And so on January 1st, 2020, they're going to receive the par value, $150,000. And, of course, the bond payable is listed at its par value of $150,000. And so now we have to figure out what the interest payments are. And so you can see the calculation here. It says interest payment, which is going to be a credit to cash. You take the par value, you multiply it by the bond rate, which in this case is 7%. But remember, interest is paid semi-annually, so that means each interest payment is 1/2 of that bond rate, so it's 3.5% rather than the full 7%. And so the 6/30/2020 cash payment for interest is $5,250, and that then is the interest expense. And then the same exact journal entry on 12/31/2020. Again, I'm hoping this is a fairly easy one. The next one's a little more difficult, but it's not too bad. So now bonds issued at a discount. So let's say that in the previous example, instead of the bond being issued at 100, let's say that it's issued at 96. So what does this imply? First of all, it means that the bond price is below the par value. In fact, it was 96% of the par value, which means that it has been issued at a discount. All right. So now it must be the case that the bond rate is less than the bond yield. That's something we also can conclude if it's been issued at a discount, meaning that the interest that's being paid is less than what the market demands. And then with the straight line method, the nice thing is we don't have to solve for the bond yield. I will say on the test, you're going to need to solve for the bond yield. We're going to get to that, but I just want you to be aware that that is going to be a requirement. All right, so now you have to record the interest payment, which is the credit to cash, and you also have to amortize the discount on the bond payable. And so the normal account balance for a discount is a debit, and so the amortization is basically a reduction to that account. And so each entry to reduce the discount is going to be a credit. And so the interest expense then is derived from two things. So the interest expense is derived from the cash payment as well as the amortization. And so in this case, the interest expense will not be the same as the interest payment. With the par bond, they were, but with the discount, they are not. Okay, and now since we use the straight line method, the nice thing is that the amortization of the discount is the same every single period. And the interest payment is fixed, the same every single period. And so with the straight line method, the interest expense is going to be the same every single period. So let's kind of operationalize this. And so the same exact situation, but instead of being issued at par, it's issued at 96. And so the issue price is 96% of the par value, which means the proceeds that they're going to receive is $144,000. And so at the issuance, you can see that the debit to cash is $144,000. There is a debit to the discount on bonds payable of $6,000, and of course you have the par value of the bond being carried at $150,000. By the way, the bonds payable account is always credited for the par value. It doesn't matter whether it's issued at par, at a discount, at a premium. It's always issued. It's always carried at the par value. If the issuance is priced differently than par value, then you create this additional account, this discount. If it were issued at a premium, it would then be a separate account called a premium on bonds payable. So now we get to the interest payments. And so the first, of course, the calculation of the interest payment, the contract hasn't changed, and so the interest payment is still the exact same, $5,250. The difference here, though, is we do need to amortize the discount. Now, the initial discount balance, if we kind of look back, is $6,000. With the straight line method, that discount is going to be amortized over the entire life of the bond, which would be 20 semi-annual periods. And so the amortization of the bond each period is $300. And so we have the journal entry, we have the cash payment, $5,250, and we have the amortization of the discount of $300. And so from that, we can sort of back into or infer our interest expense is the sum of the two, $5,550. So again, the interest expense is a function of both the interest payment and the amortization of the discount. I'm just going to pause there for 1 second. First of all, I need a drink. Okay. Same exact journal entry on 12/31/2020, because with the straight line method, every single interest payment is going to look exactly the same. All right, so now bonds issued at a premium. So again, back instead of 100, let's say now that it's 102. What does that imply? Of course, now we're in a situation where the bond price is above the par value, and in fact, in this case, it's 102% of the par value, and so the bond is being issued at a premium. What does that mean? It means that the bond rate must be above the bond yield, which means that the interest that's being paid is more than what the market demands. Again, with the straight line method, we don't actually have to solve for the bond yield, but we know that to be true in the back of our minds. And so now, again, you have to record the interest payment, and now you're going to be amortizing the premium. Now, the interesting thing here is that the normal account balance for a premium is a credit. And so to reduce that account, you need to debit the premium. And so you're going to have a credit to cash, and you're going to have a debit to the premium. With the previous example, we still had the credit to cash, but we had a credit to the discount. And so now the interest expense is going to be derived from the cash payment and the amortization, the exact same thing that we had done for the discount. And again, since we're using the straight line method, every single journal entry is going to be exactly the same, and so the amortization is the same, the interest payment is the same, which means the interest expense is going to be the same every single period. All right, so let's walk through the exact same contract, but now just a different issue price. So the issue price is 102% of the par value, and so that means the company is going to receive $153,000 at issuance. And so again, you have the bond payable being carried at the par value. The account balance on the premium is $3,000 because we receive cash of $153,000. The cash payment is the same, $5,250. That has not changed. Now the amortization is a little bit different, because if you remember here, the premium balance is $3,000. And so we're going to amortize that premium over 20 periods, which means there's $150 of amortization every single period. And so that means we have the cash payment, $5,250. The amortization of the premium is $150, but notice that it is a debit to the premium on bonds payable account because we're reducing an account that has a normal credit balance. And so we infer an interest expense of $5,100. So that's the June 30th entry, and you have the exact same journal entry on December 31st, 2020, and every single payment after that until the bond matures. Okay. Now we're transitioning out of the very simple, very simple straight line method into the effective interest method. And just so you know, under IFRS, they don't even allow the straight line method. So the effective interest method is much more widely used across the country or across the world or around the world. So just be aware of that. Important concept from the straight line method that we need to think about and apply to the effective interest method. That the total interest expense over the entire life of that bond is the sum of all the interest payments, and that is contractually driven, plus the discount. Or if you're in a situation of a premium, the total interest expense is the total interest payments minus the premium. So if you kind of think about that, no matter what, like the total interest expense is a function of two things: the contractual interest payments and either the discount, which is in addition to it, or less the premium. And that's just driven by the contract and driven by the price that you get. And so what's the implication from that for the effective interest method? And this is important. The total interest paid and total interest expense is the exact same as what we would have recorded under the straight line method. The contractual interest payments don't change. The price doesn't change. The way that we amortize this discount or premium, it does not change the fundamental aspect of what interest payments are you making, what are you paying back at maturity, and what did the market give you for that bond at the beginning. That doesn't change. And so what that means, though, is while the total interest paid and the total interest expense is the same, the timing of the interest expense is going to be different. And the reason that the timing is different is because the method of amortization is different. We're going to see this play out, but I just want you to understand, like, the method of amortization does not change the total interest expense, but it changes the timing of the interest expense. All right, let's continue with this. So the effective interest and straight line methods, they apply to the method of discount or premium amortization. It's all about the method. It doesn't change the total amortization. It doesn't change the contractual interest payments. It just changes the timing or the way that we amortize the discount or premium. It's sort of like when you talk about property, plant, and equipment. And if you have depreciation, you can use the straight line method, you can use double declining balance, you can use sum of years, all that kind of stuff. But the total depreciation is the same. It's just a matter of when you record it. Same idea here. So in this case, though, when you have the effective interest method, you must solve for the bond yield. You absolutely must solve, and you will use the bond yield. So it is more complicated than the straight line method. All right, let's kind of walk through a discount bond. So Panther Company issues $250,000 5-year annual 6.5% bonds on January 1st, 2020. They pay interest on December 31st each year, and the bonds are issued at 96. Let's provide journal entries for these first 2 years and for the maturity date. So first thing we have to walk through, and hopefully this is the same as we've always done. The issue price is 96% of par value, which means the cash proceeds are going to be $240,000. So we do that journal entry. We know that the cash that we receive is $240,000. The par value of the bonds payable is $250,000, which means that the balance for the discount is $10,000. So now we got to figure out the interest payments. Well, the contractual interest payment is the bond rate, which is 6.5%, applied to the par value, which is $250,000. And so the interest payment is $16,250. That's the contractual obligation that the company has for paying interest. So now we're going to take this information and we're going to solve for our yield. Again, we need to use this yield in order to figure out how to amortize the discount. Because as we amortize the discount, we'll use that information in order to record our interest expense. And so now we have to kind of go through our information. That's a 5-year annual bond, so our N is 5. The PV is the proceeds that we get, so it's a positive $240,000 because as the issuer, I'm receiving $240,000. The payment is, we just calculated, is $16,250. Again, as the issuer, that's a payment that I'm making, so that's a negative cash flow. And of course, then the par value is the amount that's going to be paid at maturity. That's a negative $250,000. And then Samantha has a rate of 7.488. So let's see if anybody else can get that. So I'm going to give it a minute here and see if anybody else, how many of you can solve for the correct discount rate or bond yield. Harry got the same. Kelly got the same. If you're not getting it, check the negatives and positives. That's sometimes a very common mistake. Good job. Yep, everyone's getting it. Good. Yep, 7.4884%. Now, some students ask, is it okay if I round? It's okay if you round. I would say I would be careful if you round. I always take it out this far. I take it to 4 decimal places because that minimizes rounding errors. If you were to round, let's say you did 7.5%, for the test, you probably would be okay. But if you created an amortization table that was too lengthy, at the end of it, you'd get some really big rounding errors. And so I would avoid it. I would just go out to 4 places and leave it at that. All right, so now let's talk about how to create an amortization table. Because remember, what we're doing here, again, just kind of getting back to what we're doing, is we need to record these interest payments. Part of recording the interest payment is also accruing or recording the interest expense. The method of amortization tells us what interest expense we need to record. And so that's what this table is being used to do. It's being used to reconcile the interest payment, the amortization of the discount, and the interest expense. And so this information is important to be able to kind of bring together. And so the first thing we have to figure out is, well, what is the interest expense? The interest expense when we're using this method is the bond yield times the carrying value. That's how we calculate the interest expense. And then the amortization is the difference between the interest expense that we calculate and the interest payment that is made. So again, the interest expense is the bond yield times the carrying value, and the amortization is the interest expense that we just calculated minus the interest payment. Okay, so let's apply it to this example. And so on 1/1/2020, we have a carrying value of $240,000. So let's kind of walk through that first line. All right, so 12/31/2020 is that first interest payment. We calculated the interest payment as $16,250. The interest expense is the bond yield, that's 7.4884%, times the carrying value. And the carrying value was $240,000. And so when we take 7.884%, multiply it by 240,000, we get 17,792. So that is the interest expense that we would record. The difference between the two is the amortization, 1,722. And so notice that with this discount, we started at 240,000. The new carrying value is 1,722. And the implication there, this is very important, is that the carrying value is increasing over time. And so it's starting at 240,000, which is the discount, and then it will end up at 250,000. And so the path is determined by the amount of amortization. And so again, if you kind of think about the amortization of a discount with the straight line method, it's a straight line, right? It's going up in a straight line. With the effective interest method, it's kind of going up in a curve, but it's still going to end up, it's going to kind of start and end in the same place. All right, so let's see if anybody, I want you to try to do the next line on your own. So for the 12/31/2021 date, I want you to see if you can calculate, kind of fill that row out on your own. It should be kind of sitting in front of you, and so I just want to make sure you can calculate everything. And so I know even in the notes, I've filled it out for you. You need to be able to calculate this information. And so we have the payment. Hopefully you understand that's the same. And then we get the interest expense. Nirmal Kamoor got it, and Abdul got it. Yep, 18,101. Good. It's the bond yield times the carrying value. So the bond yield, 7.4884%, times the new carrying value, 241,722, which gives us an interest expense of 18,101. And of course, the amortization is the difference. And notice then, as we follow it the rest of the way through, we're going to end up at the par value. So now let's take this amortization table and apply it to our journal entries. And so the first journal entry is 12/31/2020, and so we're going to be focused on that first full or completed row. And so we're kind of walking through it. We can just take the information from the table and populate our journal entry. So the cash payment is $16,250. We calculated the amortization of the discount is 1,722, and the interest expense is 17,972. So notice sort of the accounts are the same, but of course the amounts are a little bit different for the interest expense and the discount compared to if we had used the straight line method. But hopefully, once you do the table, these journal entries aren't too bad. So then with the 12/31/2021 journal entry, we just move down the next row. Same accounts, just different amounts. And so the cash payment is the same. Now, of course, the amortization of the discount is a little bit different, which means that the interest expense is going to be a little bit different. And then finally, we come to our final journal entry on 12/31/2024. In this case, not only do we have the final interest payment, but we also are repaying or paying the par value on the bond. And so the cash payment that you notice there is the interest payment of $16,250 plus the repayment of the par value of $250,000 for a total of $266,250. The discount amortization is the same, of course. The interest expense is taken from the table, and of course now we're getting rid of the bond payable as well. 17,972. Did I have a typo? I may have a typo, I don't know. Let me see. It's 972. Yeah, I just calculated again, Samantha, so I don't know. 972. What did I say? Who said 17,792? Did I have the wrong number? I see 17,972. I think it's right. Oh, in the previous slide, did I have it wrong? Oh my gosh, yes. All right, thank you. Yep, previous slide, it was wrong. Thank you. Got it. Yeah, somehow I missed that. Yep. All right. Thank you, Samantha. All right. Let's talk about a premium bond now. So now we issue $350,000 in 3-year semi-annual bonds. Each one has a 7% bond rate. We issue them on May 1st, and the bonds pay interest on April 30th and October 31st each year, and they're issued at 103. Now, this one's a little more complicated because the interest payment does not coincide with the fiscal year end, and so that's going to create an issue that we're going to have to work through, and so we're going to kind of walk through that as part of this problem. Now, the initial things, nothing changes here. We still kind of calculate the issue price by using the 103% and applying it to the par value. And so, of course, we have our cash proceeds, we have the face or par value of the bond, and the premium then is the difference, the $10,500. Hopefully that journal entry at this point is very, very easy for you. Again, same issue price, nothing going on there. Now we calculate the interest payment. Now notice it's a semi-annual bond. The bond rate is 7%, which means that each semi-annual period, the bond will pay 3.5% interest on the par value of $350,000. So each interest payment is $12,250. And so now we use this information in order to do our time value of money calculation. So our N is 6, again, because it's 3 years, but each is a semi-annual period, so 6 semi-annual periods. The price we calculated, the payment we calculated, and of course the par value. And so then we need to solve for the I/Y. And again, I'm hoping by now this is becoming easier for everybody. But the I/Y is 2.9472%. So that is the semi-annual bond yield. So the semi-annual bond yield is 2.9472%. So then with the amortization table, the process here is the same. We calculate the interest expense the same way, the amortization exactly the same. Now the only thing that's a little bit different is if you notice that the present value of the bond is more than the par value. So with the discount, that amortization was increasing the carrying value of the bond. But with the premium, the amortization is going to decrease the carrying value of the bond. And so let's kind of watch that play out a little bit. So the first interest payment happens on October 31st, 2020. We have that contractual interest payment of $12,250. We calculate the interest expense again by taking the bond yield that we just solved for and we apply it to the carrying value. And then the difference then is the amortization of the premium, which as the premium is amortized, the carrying value of the bond is going to decrease. And so then we kind of complete the whole chart in order to get down to the final carrying value, which is the par value. Now, notice that within this chart, I did not insert a fiscal year end. If you kind of think about this, this is just math. And so when you create an amortization table, it's just math. And so it doesn't care when December 31st is. It's just accruing every 6 months and reducing, or basically reducing that premium. And so it doesn't matter whether it coincides with the fiscal year end or not. What you need to do is create your amortization table around the interest payment dates, regardless of the fiscal year end. And so notice this is how it should look whenever you have a situation that doesn't coincide with your fiscal year end. Now, it doesn't mean the fiscal year end is unimportant. We do have to account for it. It just means that it's not part of this calculation. All right, so now we're going to start going through our journal entries. And so we start with our October 31st, 2020 journal entry. And again, this is something we've done all along. Hopefully this isn't new. We have the cash payment. We have the amortization of the premium as a debit to that account. And then our interest expense is something we calculated, $10,625. Now the next one's a little bit different. So I have a little dotted line around this row. And the reason I have a dotted line around this row is because this is the row where we kind of cross over a fiscal period end. And so because we have that situation, at the end of each fiscal year, if you remember even from what we talked about with the current liabilities, if there's interest that's accruing and you hit a fiscal period end, you have to accrue interest for whatever part of that time expired. And so you have to make this adjusting entry at the end of your fiscal period to deal with the fact that you have this bond that is accruing interest. And so as we kind of work through it, we know that a full interest payment would be $12,250. Now from October 31st to December 31st, 2/6 of that interest payment accrued. In other words, now there's this contractual obligation to pay interest. Now you haven't paid it yet, but you do owe it. And so now we have to accrue partially that interest payment. And so 2/6 of $12,250 is $4,083. And so we have this accrued interest. We also have to accrue the interest expense. So again, the full 6 months of interest expense would be $10,577. We're accruing 2/6 of that, which is $3,526. And then kind of along with that, then of course, we can see those two things don't equal. We also then have to partially amortize the premium. And so you can see that the amortization of the premium is also 2/6 of the full amount. And so 1,673 times 2/6 is $557. And so what we're doing is basically we're just kind of, if you kind of think about this 6-month period, 2 months happen in 2020 and 4 months happen in 2021. So on December 31st, we need to account for those 2 months, which is the accruing of the interest payable and also then the recording of the partial interest expense and the partial amortization of the premium. So usually when students get tripped up, it's usually here where they start to get a little bit tripped up, that partial accruing of interest. So then now we're going to move on to our April 30th journal entry. Again, we have the remaining interest expense. Remember, we already accrued $3,526, so now we need to accrue the rest of it, the $7,051. And so we have the interest payable that was from our prior journal entry. Now that we're making the interest payment of $12,250, that payable goes away. We also accrue now the new interest, and then of course we need to amortize the remainder of the premium. And so that's why we have the $1,116. That's the remaining amount of the premium that needs to be amortized. So again, as long as you correctly accrue at the end of the fiscal period, then the remaining 4 months hopefully would be fairly straightforward. Just have to keep all the moving parts in place. So then we're going to kind of fast forward to the end. And the reason why I like to fast forward to the end is because it kind of makes you conceptualize what's been going on. So we know that every October we're making an interest payment. Every December 31st, we're accruing interest, and then every April 30th, we're paying interest again, and that continues on and on and on until we get to April 30th, 2023. And so on that date, we have to think, well, what had previously been accrued? And of course, the same amount of interest gets accrued between October 31st and December 31st. It's 2 months. So there had been a partial accruement, or there's been the interest payable that got accrued in the amount of $4,083, and that would have happened on December 31st, 2022. Of course, there would be the remaining interest expense because we would have previously accrued 2/6, which means on 4/30/2023 we need to accrue 4/6 of $10,371. And so when we throw that into a journal entry, the interest payable is there, the interest expense is there, the cash payment includes the repayment of the par value plus the interest payment, and of course then that doesn't all equal out, and the reason why is because there's still 4 months of amortization to account for, and so 4/6 of $1,879 is $1,253, and so that's how we get to that final journal entry. Again, the reason why I skip ahead is because it kind of forces you to conceptualize what's going on. And so also just on a test, be aware that I may create a question where you're kind of placed in the middle of a situation and you need to be able to understand what happened previously. Now, that's not all questions. I don't want you to think like every question is going to be that hard, but there will be some questions that are going to challenge you in that way. All right, so bonds issued in between payment dates. So if a bond is issued in between interest payment dates, you have a slight problem. And the problem is that the contract and the rights of the bondholder don't quite marry up. And so the contract calls for a full payment on the next interest payment date. In other words, the contractual interest payment is fixed. However, the bondholder is not entitled to the full interest payment. In other words, if I don't buy the bond, let's say that an interest is going to be paid on December 31st, and it's an annual interest payment. If I buy the bond, let's say that I'm issued the bond on June 30th. Well, 6 months occurred where I didn't even hold the bond and they didn't have my money. And so I'm not really entitled to a full year of interest. However, on December 31st, I'm going to get paid as if I had the bond for a full year. Hold on a second, I got my older son arguing with his mom. Sorry, I've got a 13-year-old who doesn't want to mow. All right, so the bondholder is not entitled. So in other words, how do we handle this situation where you're going to receive a full interest payment, but I'm not entitled to it? Or more importantly, from the issuer's perspective, I'm going to make a full interest payment, but the person who holds that bond is not entitled to all that interest. So how do we reconcile that? And so what happens is the bondholder has to prepay any interest that they're not entitled to. They have to prepay it. And so that's how we handle that. In a strict sense, I want you to be aware that the bond yield is going to take this prepayment into account. I'm not going to complicate your life by creating an issue with this. I'm just going to, the bond yield by definition includes the timing of this prepayment. All right, so 49er Company issues $250,000 of 6% 5-year annual bonds on March 1st, 2020. Now, pay attention here. The bonds pay interest on December 31st each year. And so now we need to record the journal entries for 2020 and 2021. And so notice, though, that the interest payments are annual interest payments. They're paid on December 31st. But the bond did not get issued until March 1st. So basically now January and February, the bondholder did not give you any money. So they are not entitled to those 2 months of interest. However, on December 31st, they're going to get paid the full interest payment. And so now we got to handle that through a prepayment of the interest. And so how does that work? Well, the prepaid interest is, of course, the $250,000 par value times the bond rate of 6%. And, of course, there were 2 months where they didn't hold the bond. And so we multiply that by 212. So the prepaid interest is $2,500. And so then the journal entry, though, is there's two ways to handle the prepaid interest. I'm going to use the one that's most common and the one that's used in the book. So first of all, the bond is issued at par. In other words, there's no premium or discount, so we don't have to worry about that for this problem. And so the bond holder is going to give you the par value, $250,000, plus the prepaid interest of $2,500. Now the bond payable is carried at its par value of $250,000, and then that difference, that prepaid interest, we're going to have as a credit to the interest expense. And the reason that we credit the interest expense is that at the end of the year, we're going to record interest expense. And so the method that we're going to use is basically there's going to be a netting out. There's going to be sort of a net interest expense over the course of the year. There are other ways to handle it, but I think this is the one that's the most straightforward. So basically we have, again, there's this sort of temporary credit to the interest expense, but you're going to see on December 31st, 2020 that it's going to get netted out. And so then fast forward to the end of the first year, and we have the full interest payment of $15,000. And so notice, though, on 12/31/2020, the cash payment is $15,000. There's no discount or no premium, which means that the interest expense then is $15,000. And so if you think about it, there was a credit of $2,500, and now there's a debit of $15,000. And so there's a net debit of $12,500 for our interest expense in 2020. And so when we report on our financial statements the interest expense for this bond in 2020, the amount that's going to be reported is $12,500, which reflects 10 months of interest expense, which is correct. So the total interest expense then for 2020 is $12,500. And then on 12/31/2021, again, same journal entry, the cash payment and the interest expense, but of course in that year there's no offset, so the interest expense from 2021 would be the full $15,000. So now a slight difference here. Instead of having a bond being issued at par, we're going to have the bond issued at a premium, and we're slightly changing the date from March 1st to May 1st. So it's just going to be a little more complicated. So again, the prepaid interest is 6% times $250,000, but now, of course, there's 4 months of prepaid interest. The issue price is 103% of par value. And so in this case, then, again, the cash payment is the price plus the prepaid interest, for a total of $262,500. The bond payable is carried at the par value. The premium is the issue price less the par value, and so that's why we have $7,500 for our premium on bonds payable. And of course, then the interest expense is the amount of prepaid interest. And then on December 31st, we're going to record the interest payment of $15,000. Now the amortization of the premium is a little bit different. The premium balance is $7,500. This is a 5-year bond, but the bond's actually not outstanding for a full 5 years. It's actually only outstanding for 56 months. And so the way I personally do this is I just think of it then, okay, rather than thinking of annual periods, I think of months. And so I'm going to straight line amortize this premium over 56 months. And so the amortization of the premium is about $134 a month. And so for 2020, there'd be 8 months of amortization for a total of $1,072. And so when we get to the journal entry, we have the cash payment of $15,000 and the premium amortization of $1,072, which means that our interest expense is $13,928. But of course, remember, we did have that credit to our interest expense of $5,000, and so in 2020, they're going to report interest expense of $8,928. Again, that's just kind of combining this journal entry with the previous journal entry. Notice the credit to the interest expense of $5,000 on May 1st. Hopefully that makes sense. This is probably where it gets about as complicated as it can get with this type of situation. So then in 2021, can we assume straight line amortization? Yes, I will explicitly tell you if I want you to use effective interest. And I think in all the questions I tell you to use straight line as well. So I think I'm always very clear. Good question, Harry. So in 2021, of course, it's a full 12 months, and so the amount of amortization is a little more. Of course, the interest payment is the same, but the interest expense is going to be $13,392 compared to the previous year, $13,928. And of course, the reason for that is the difference in the amount of amortization of the premium. All right, so now we're going to transition to looking at notes. All right, so we've been working about an hour here. Hopefully everybody's hanging in. All right, so what is the difference between the face value of a note and the present value of a note? And by the way, there are some differences between a bond and a note, but essentially they're very similar. It's an obligation to repay a certain amount at a future date. Sometimes the note's going to have interest as part of it, sometimes it's not. Bonds sometimes don't have interest as part of it. So just be aware that while we make this distinction, notes and bonds behave very similarly. So the nice thing is a lot of the math is not going to be new. It's going to be similar. But just kind of getting back to this, what's the difference between a face value of the note and the present value of a note? The face value is the amount that's going to be paid at maturity. It's a contractual obligation to make a payment at maturity. The present value is the discounted cash flows associated with the debt, which of course would include the payment at maturity, but could also include contractual obligations to pay interest. Now this is important. The face value will equal the present value if and only if the effective rate implied by the debt contract equals the most reliable rate applied to the debt. So in other words, if through the contractual arrangement in the note, the effective interest rate is 5%, and let's say that 5% is the most reliable way to discount that debt. In other words, the most reliable assessment of the market risk associated with that debt. If that's true, then the present value and face value are going to be equal. If that's not true, then the note is going to be issued at a premium or at a discount. So basically, if and only if the inferred effective interest rate is equal to the most reliable rate, in that case, it will be issued at par. In every other case, it's going to be issued at a premium or at a discount. So you have to apply time value of money to long-term notes. And so if there's ever a situation where it's not issued at par, you have to use the effective interest method with this note. You do not have the option of a straight line method. All right, so notes issued at face value. This is where the present value and the face value are equal. So that means the interest rate implied in the notes contract is equal to the most reliable discount rate. These are really, really easy. These are the simple ones. The interest payment and interest expense are equal. Zero interest bearing notes. This is a little bit different. So the present value and the face value are not equal. And the reason we know that is because the present value is going to be less than the face value. In other words, the note is going to be issued at a discount. Of course, the reason we know that to be true is because the note rate, the rate on the note, is 0%. Well, that's never going to be the market rate of interest. 0% is never, ever, ever going to be the market rate of interest. And so the note is going to be issued at a discount, and the discount is what's going to allow us to determine the most reliable discount rate. The higher the discount, the higher the discount rate, the greater the discount. So basically, as that discount goes up, that means that the rate is going up as well. So in this zero interest bearing note example, it's a $50,000 zero interest bearing note on January 1st, 2020. It was issued for $44,000. The note matures on December 31st, 2022. Let's provide all the journal entries. And so the initial issuance hopefully is fairly straightforward by this point. The note payable, the face amount is $50,000. The cash received is $44,000, which means the discount on the note payable is $6,000. And so we're going to have to use that information in order to get the discount rate. Remember, you have to use the effective rate, and so we need to solve for that yield on the note. So the N in this case is 3. The reason we know it's 3, it's 2020, 2021, 2022, 3 full years. The present value of the note is $44,000. That's what I received today. There are no interest payments, and of course we're paying back $50,000 at maturity. So when we solve that, the annual yield on the note is 4.3532%. So now we're going to use that information to create the amortization table. Now this one's a little bit different because there's no interest payment column. Since there's no interest payment column, the interest expense is also going to be the amortization. And so the interest expense is calculated the same way we always have, which is the yield times the carrying value. And so on 12/31/2020, we take that yield of 4.3532% and we apply it to 44,000, we get $1,915. Now again, this has been issued at a discount, and so the amortization is going to increase the carrying value of the note because the balance in the discount is getting smaller. Repeat that process for the final 2 years, and of course the note ends up at the par value, or the face amount of the note. So then let's translate this to some journal entries. So on 12/31/2020, we're going to amortize the discount on the note payable for $1,915, which of course that's also the interest expense. And so the two together gets you to the journal entry for 12/31/2020. On 12/31/2021, of course, it's the same process. We're still amortizing the discount, but now of course the amount has changed. So Henry says, so in the case of a note, we only apply, that is correct, Henry, that is the only allowable method for a long-term note is the effective interest method, 100% true. With a bond, it can be either one. And then finally at maturity, again, we have the interest expense from the table, which is also the amortization of the discount, and of course we do have the repayment of the note for $50,000, which is why we have a credit to cash, and we take the debt off our books with a debit to the note payable. Again, hopefully this one's not too bad. I think the only kind of difference here is the amortization table is a little bit different. Alright, so now notes issued at a premium. So now it's going to get a little harder. So again, the present value of the note in this situation is going to be greater than the face value. The interest payments are more than what the market demands. And so we're going to amortize the premium using the effective interest method. Of course, that's what we have to do with the long-term note. Similar approach if it was issued at a discount. All right, so let's walk through this. So Panther Company issues a 2-year note payable on August 1st, 2020. The stated rate on the note is 8%, and that's paid on July 31st each year, starting in 2021. The $35,000 note is issued for $38,000. So let's provide all the journal entries. Hopefully the first journal entry is not too bad. We received $38,000. The face amount on the note is $35,000, which means the premium on the note must be $3,000. And then we're going to use the effective interest method in order to amortize the premium. But in this case, of course, we also need to record interest payments because we have this note that has a stated rate of 8%. Or sorry, we need to accrue interest as well. And so let's solve for this. First of all, we get an n equal 2 because it's a 2-year note. The PV is the amount received is $38,000. There is a payment of $2,800. Again, the payment is 8% of the face amount of $35,000. That's where we get $2,800. Of course, then the face amount is $35,000. Again, hopefully by now, I'm hoping that you kind of understand where all these numbers come from. So I'm moving a little more quickly. I understand that. If I pop up a number and you don't know where it came from, please just put it in the chat. Hey, where'd you get 2,800 or where'd you get 38,000 or whatever it is, and then we can solve, or I can help you figure it out. And so when we solve for that, we get the I/Y as 3.4887%. So that's the rate, that's the most effective rate, or that's the most reliable rate on this note. So the note is paying 8% interest, but we're saying here is the market demand for interest is only 3.4887%, which is why the note is issued at a fairly substantial premium. So now with this amortization table, there is payments, and so now we kind of go back to what we had seen before with the bond. This is going to feel just like the premium bond table. Now again, there's the first interest payment is on 7/31/2021. The payment is for $2,800. The interest expense, again, just kind of repeating the process. You take the carrying value of the note, you multiply it by the yield, and the yield we had solved was 3.4887%. So 3.4887% times 38,000 is where we get the 1,326. Now again, this is a premium, and so the carrying value of the note is going to decrease with the amortization until, of course, by the end we arrive at the par value of 35,000, or the face amount of the note of 35,000. So again, this amortization process is the same whether it's a bond or a note. You just have to kind of be careful about the terms to understand how that amortization table really needs to look. So we're going to take that information and we're going to start doing our journal entries. We already recorded the issuance, but now we got to figure out, okay, on December, the reason, again, the dotted line around that row is because we cross over a fiscal year end. So on December 31st, 2020, we have to record the fact that there's this note that's outstanding, and that note has been accruing interest. And so we need to record the interest expense and the accrued interest related to it. And so the interest expense, of course, would be 5/12 of the full year of interest. The full year of interest expense would be 1,326. 5 months of that occurred in 2020, and the remaining 7 months will occur in 2021. And the same thing with the interest payable. Notice the interest payable is based on the interest payment, whereas the interest expense, hopefully it's obvious, is based on the interest expense. So those two amounts aren't the same. And so given that the two amounts aren't the same, the difference then is the partial amortization of the premium. Again, also 5/12 of 1,474. So we're amortizing the premium, we're accruing interest payable, and we're partially recording our interest expense based on the 5 months since the note was issued. Hopefully that makes sense. Again, this is very similar to what we had done with the bonds. All right, so now we have the July 31st, 2021 journal entry. So we have the remaining interest expense. So we have the 1,326 minus what we had previously accrued, which is $773. Of course, we're getting rid of that interest payable. The cash payment is a full $2,800. And the difference then, of course, is the remaining amortization of the premium. Again, moving parts, but I think with enough work, you can remember all those moving parts. And hopefully these journal entries, again, are something you're getting more and more familiar with. So then, kind of moving on now. So again, now we're going between July 31st, 2021 and July 31st, 2022. So now we're passing through December 31st, 2021. And so again, same process. We need to accrue the interest expense. We need to partially accrue the interest payable, and we need to partially amortize the premium. And so we did the same calculation. Of course, we're just applying it to different amounts. So it's still 5/12. And so with the journal entry then, hopefully it's fairly obvious that, again, we got 5/12 to accrue the interest payable based on the 2,800, 5/12 of 1,274 to get our interest expense, and then 5/12 of 1,526 to get the partial amortization of our premium. And then with the final journal entry, we do have the remaining interest expense. Along with the remaining interest expense, of course, the payable comes off, but we are also repaying the note. And so that final cash payment is not only the interest payment of $2,800, but also repaying the face amount of the note of $35,000. And so then the premium amortization then is the remaining amortization of $890. Again, lots of stuff going on with this one for sure. But hopefully you're able to follow that. Okay, so now this section is basically some special situations that can arise related to notes. So when a note is issued for cash, this is kind of important, is the cash really is allowing you to estimate the fair value of the note and the inferred interest rate related to the note. In other words, the cash is what we're using to value the transaction. So what happens if cash is not part of the transaction? In other words, what if I issue a note and I receive a non-cash benefit for that note? Well, now I don't have cash as this highly reliable way to value the transaction. And so now what we got to do is figure out, okay, how do I do this? How do I figure out what the fair value of the note is? How do I infer the correct interest rate? Like, how do I do that if I don't have cash? And so you have to find a way to obtain the most reliable estimate to value the transaction. So you got to figure out, well, how can I reliably estimate this? And so the way that we do that is there's two halves to this. There's there's sort of the idea is, well, what is a normal interest rate or a comparable interest rate for a note? And we compare that to the fair value of the asset or liability that's on the other side of the transaction. And so you're kind of like, okay, which one do I use here? Is there a way for me to value the note and that's more reliable, or is there a way for me to value the other item and is that more reliable? And that's the assessment that everyone needs to make as an accountant whenever you have a situation where there's a non-cash transaction. So typically there's two choices that you're going to have to figure out the most reliable estimate. Number one, the fair value of the asset or service received, or two, some sort of discount rate that you infer from comparable debt transactions. And so in other words, a lot of times the company has other debt that's outstanding, and you can say, okay, well, that's comparable, and so what's the debt related, and what's the rate for that debt? Maybe we can apply that rate to this debt. Or maybe it's like, oh, well, this asset, there's a bazillion of these assets out there, and I can reliably estimate that. It's not clear what you have to do every single time. Now, I will say, for the purpose of our test, it will always be very clear that one is more reliable than the other. All right, so let's kind of talk about how we do this. So with fair value estimates, there are three levels. The first level, which is a level 1 fair value, these are situations where there are quoted prices in active markets for identical assets or liabilities. All right, so in other words, now I have comparable transactions for identical items. As an example, let's say that I issue a note, and in exchange I get Microsoft stock. We're going to talk about that example in a second. Well, how many shares of Microsoft stock are traded every single day? Millions and millions. And those shares of Microsoft stock are identical to the shares that I'm about to receive. And so I can use those third-party transactions to value this transaction using a level 1 fair value. So I might take like an average trading price from that day or something like that. That would be a very clean example where we have a level 1. Level 2. These are where there are market observables to indicate the fair value of an asset or liability. Basically, there are comparable transactions for similar items, not identical, similar. So as an example, usually when you issue debt, you issue the note. If you have other debt that you've issued, you probably could at least have a similar transaction to look at. Well, I issued a note last year, and the interest rate on that note was 5.5%. Okay, that's comparable. Nothing's really changed. And so maybe 5.5%, that's comparable. That's a level 2 fair value. Or maybe I can look out at interest rates in the broader market, and I can say, well, most people when they do, when they're borrowing money for 6 months for 2 years, the prevailing interest rate is 3.5%, whatever it might be. But there are comparable transactions for similar items. And so like in this example, if I had a choice between Microsoft stock or similar debt transactions, well, the Microsoft stock is more reliable because I can look at identical transactions, whereas with the debt I can only look at similar transactions, and so you have to assess which one was more reliable. Now the final level is a situation where there are no market observables and the transaction at hand is unique. This a lot of times is with intangible assets like trademarks and copyrights and things like that, because by definition a trademark is unique, and by definition a copyright is unique. There may be some like rural land with minerals, like with mines on them or something. Well, that this land with a mine is different than another strip of land that has a mine on it. There might be art, maybe it's art that you're exchanging. Well, art's a unique item by definition because it's a unique piece of art. And so again, level 3 basically is unreliable. And so very rarely will you have a situation, well, in practice, very rarely would you have a situation where you have one level 3 that's being exchanged for another level 3, where you're just like, oh, what do I do? And just be aware of that. That's very in this class, that's never going to happen. I'm never going to put you in that situation where you have to guess. Similarly, I would say that sometimes you'll have 2 level 2s though, in practice, or 2 level 1s, where then it's getting down to sort of like, okay, I've got 2 level 1s, which one do I feel more comfortable with? Or I've got 2 level 2s, which one do I feel more comfortable with? And in those situations, that's where judgment comes into play, and you have to sort of assess and say, okay, well, we chose this one and here's why. For this class, there will always be different levels on each side of this transaction. I'm never going to have two level 2s. One will be clearly a level 1 and the other one will be clearly a level 2. Or one will clearly be a level 2 and the other one will clearly be a level 3. I'll make sure that it's very clear that one is more reliable than the other. So within the context of notes payable, it's likely that you will always have a comparable debt instrument. So in other words, you're always going to have the option of a level 2 fair value. The good or service on the other side of the transaction, that could be a level 1, that could be a level 2, or that could be a level 3. Each situation might be different. But of course, for this class, I'm never going to give you a level 2. It will either be a level 1 or a level 3 that's on the other side of this transaction. So whichever one you do, you choose the most reliable. Whichever one's the most reliable, that's going to drive the entire transaction. So let's kind of talk about this as an example. So Panther Company issues a $45,000 note in exchange for $41,000 in Microsoft stock from 49er Bank on January 1st, 2018. The note matures on December 31st, and there's no interest payments. Similar notes trade with an average yield of 5%. Provide all necessary entries, assuming Panther repays the note with cash. So basically we have situation here, which one is more reliable, the Microsoft stock or yield on similar notes. And so if you are still awake, sorry, I've been talking a long time, I know that. If you're still awake and feel like answering, which one of these is more reliable, the Microsoft stock or a yield on similar notes? Microsoft. So Harry says Microsoft. Richard says Microsoft. Paul says Microsoft. Microsoft. I'm seeing a trend. And of course, y'all are right. So Microsoft stock is the most reliable. Yep, Microsoft stock is the most reliable. So basically what we're saying is that $41,000, that's more reliable than the 5%. So remember, that's what we're comparing, the $41,000, which is the fair value of the stock, and we're comparing that to that 5% yield on similar debt. And so we're saying, well, ignore the 5% because now we have a more reliable way to measure this transaction with using $41,000. So how do we do that? So we're getting this Microsoft stock for $41,000. The note payable is carried at its face amount of $45,000, and so the difference then is the discount. And by the way, without even, well, maybe you can, I don't know, let's figure this out. How much interest expense is Panther Company going to record for this note? Over the life of the note, how much interest expense is Panther Company going to record? See if any, again in the chat, if you think you know the answer. And I'm not saying today, I'm just saying over the entire life of the note, how much interest expense will Panther Company record? No takers? Give it another second. All right. Remember, interest expense is a function of two things. So Harry says 2,250. So Abdul's not understanding. So Microsoft is a level 1 fair value. In other words, I can look at other transactions in the market for identical items. And that's always more reliable than looking at similar items, which is where we would have gotten the 5%. So we have 2,250, 4,000, 1,953. All right, so here's what we're going to do. One of those three answers is right. I'm going to tell you right now. One of those three answers is right. So on the count of 3, you're going to out loud or in the chat. I prefer that you do both. But on the count of 3, you're going to put in your answer. All right? So out loud or in the chat or both. So 1, 2, 3. So we got a 4,000. Anybody else? 4,000, 4,000, 4,000. Harry changed his answer. 4,000. Yeah, good. Yeah, it's 4,000. So Richard, it is 4,000. The reason we know this, if you remember, we talked about interest expense is a function of two things. One is contractual interest payments plus a discount or minus a premium. Now, with this particular debt arrangement, there is no interest payments. And so the only thing that's going to create an interest expense is the discount. And so since the discount balance is $4,000, we know that total interest expense over the life of this note is going to be equal to exactly $4,000. Now, the timing of the way we're going to record it is we have to use the effective interest method to figure that out. And so then we've got to go back to our TVM. So the N is, this is a 2-year note. The PV of the note is $41,000. There is no payment. And the FV is $45,000. And so we solve for the yield on the note. We get 4.7645%. So what we can see is, while there are notes that have an average yield, similar notes with an average yield of 5%, this particular note can be more reliably estimated as having a yield of 4.7645%. That's more reliable than the 5%. Again, the reason why is because the Microsoft stock is a level 1 fair value, whereas that estimated 5% is a level 2 way, or level 2 method for getting to the fair value. And so the 4.7645% is more reliable. So now let's use that information to create an amortization table. Again, there's no interest payment, so the amortization is the same as the interest expense. And so you can see after 2 years, we arrive at $45,000. Now the reason I have a little asterisk there is because if you take 4.7645% and you multiply it by $42,953, you don't get exactly $2,047. But in order for the table to be complete, I kind of rounded the other way than what you're supposed to in order to make it work. So then our journal entries hopefully are fairly straightforward. We have the 12/31/2018 journal entry. Again, the interest expense and the amortization of the discount are exactly equal. And on 12/31/2019, the same equality between the interest expense and amortization of the discount, but in this case, we also are repaying the note. So we have a credit to cash and a debit to the note payable for the face amount of $45,000. Again, I'm hoping that this one's not too bad once you kind of disentangle it as far as which one's more reliable. All right, next one. All right, same idea. So they have a $70,000 note in exchange for rural land in Wyoming. They plan to test the land for minerals. The note matures on December 31st, 2020. Similar notes trade on an active market with an average yield of 8%. Land sales are uncommon in this part of Wyoming, but a real estate agent estimates that the land is worth $58,000. So provide the journal entries assuming 49er repays the note with cash. So again, sort of which one is more reliable, the rural land or yield on similar notes? So again, in the chat or out loud on your own, which one is more reliable? Rural land or yield on similar notes? So we got yield, 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 yield. Yield, yield, yield. And everybody's right. Yes, the yield on similar notes, because yield on similar notes is level 2, whereas the rural land is a level 3 fair value. And so the yield on similar notes is more reliable. So now we got to figure out how to use this information and apply it to the time value of money to get our amortization and record our interest expense. And so again, we have our 5 buttons. We know that the N is 3 because there's 3 years between its issuance and repayment. The I/Y is what we are given as the most reliable way to value this. So the I/Y, the interest rate is 8%. There is no payment. and the future value of the note, the face value of the note, is $70,000, and so the present value is $55,568. And what essentially this is saying is that the real estate agent's estimate is unreliable, and so that $58,000 is meaningless. Like it's just not part of what we're going to even use in this transaction. Instead, we're going to focus on this present value of $55,568. And so again, we take that information, we apply it to our transaction. The note payable is carried at the face amount of $70,000. The land is assigned the fair value of $55,568 based on our time value of money. Is the discount on the note payable $14,432? Now I'm going to ask this question again. How much interest expense will the company record over the life of this note? Again, either out loud or in the chat. See if you can answer that question. So Henry says 14,432. Jason says interest equals the discount. Richard says 14,432. That is correct. So 14,432 is correct. Good job, good job. Again, the idea here that the interest expense is going to equal contractual interest payments plus the discount. Since there are no contractual interest payments, that means the interest expense is only the discount. And so now we're going to use that information to create our amortization table. Again, I'm hoping that by now these are becoming very, very familiar. And so again, in this case, the initial carrying value of the note, $55,568, and we know that as we amortize, there's no interest payment, so the interest expense and the amortization are exactly the same. We're going to end up at the carrying value. The carrying value is going to end up at the face value of $70,000. Again, with a little asterisk because with rounding, wouldn't quite land on $5,186, but it's really, really close. So I'm going to take that information to create our journal entries. So December 31st, 2018, of course, the amortization and the interest expense are exactly the same, $4,445. The same is true for 12/31/2019. The interest expense and the amortization of the discount are exactly the same. And then the final journal entry, of course, includes also the repayment of the note. But again, the same truth is still true. The interest expense and the amortization of the discount are exactly the same. Again, I'm hoping by now that these amortization tables are starting to make more and more sense. And if you're not there yet, that's okay. I mean, we've only been at this for 2 days. But that's what you're going to need to practice between now and next Monday, is really getting familiar with how these amortization tables work. All right, so now extinguishment of debt. So debt most often is extinguished at maturity. That final payment is going to be equal to the par value. And so if you extinguish debt at maturity, there's not going to be any gain or loss whenever debt is repaid at maturity. However, sometimes debt can be extinguished prior to maturity. And in those situations, there could be something that's called a call option. A call option means that the debt issuer has the option to recall the debt at a predetermined price. In other words, they can pay off the debt early. And in that situation, they also may reacquire the debt through market transactions. So in other words, if they issue a bond and it's publicly traded, they could go out and buy the bond just like anybody else. So there's sort of two ways that they could extinguish their debt. In both cases, it's unlikely that the carrying value or book value of the debt is going to be equal to the price that they paid. And so whether it's a call option or open market transaction, so if you think about the path of that debt, it's kind of predetermined, right, on an arc. It's predetermined. And so that predetermined path is not going to be equal to the market path. Now, the market path might follow it a little bit, but they're different. And so if there's an extinguishment prior to maturity, it's very likely that there's going to be a gain or a loss. Anytime that the book value of the debt is not equal to the price that's paid, there's going to be a gain or a loss. And so whenever there's an extinguishment prior to maturity, be aware that there's going to be a gain or a loss. All right, let's kind of walk through this example. So 49er Company issues $600,000 in 10-year annual bonds on January 1st, 2018 at 98. The coupon rate is 6%. And there's a call option at 101. So they have the option to call the debt at 101. And they actually exercise this call option on October 31st, 2020. Now, one thing we can kind of see here is that the issue price is 98, which is at a discount. As that, over time, we're going to use the straight line method, as we amortize the discount, the carrying value is going to increase. But remember, the path is between 98 and 100. And so it's the straight line path from 98 to 100. And so there's no way that the carrying value of the bond will ever reach 101. And so when you have a call price that's above par and you've issued the debt at a discount, that means when the option is called or when the call option is exercised, there's going to be a loss because you're going to be paying more than the book value of the debt. So with this particular example, before we do anything else, we know there's going to be a loss on the extinguishment of this debt. Now, if it had been called at like 99 or 97.5 or something like that, or not 98.5 or something like that, in that situation, it would depend on when they call it, as far as if there's a gain or a loss. But in this particular case, we know there's going to be a loss. I just wanted you to kind of think about that ahead of time. But you don't have to understand that in order to get the question right. I'm just sort of trying to highlight that as some insight that you could have on this problem. So what do they have to do? So anytime they exercise a call option, first of all, you have to record and pay any accrued interest. So they have to record and pay any accrued interest. They cannot skip an interest payment by calling it early. So if there's been 8 months of accrued interest, you have to pay 8 months of accrued interest. And of course, record any interest expense associated with that. And then of course, the second part of that is you need to record the redemption then. All right, so first of all, in this example, we're going to record the accrued interest. And so we know that the contractual obligation to pay interest is 6% of par, so 6% of $600,000, and 10 months had accrued. And the reason we know 10 months had accrued is because the call option was exercised on October 31st, with interest payments occurring on December 31st. So we record 10 months, which is $30,000. And we also have to do the amortization or the partial amortization of the discount. So we know the total annual amortization of the discount sort of as a path to get there. Since it was issued at 98, the discount balance is 2% of the par value, 2% of $600,000. Since this is a 10-year bond, the annual amortization is going to be 1/10 because we use the straight line method, which tells us that the annual amortization of the discount is $1,200. And so for this particular year, 2020, there would have been 10 months of amortization that we need to record because, of course, from January through October. So 10 months out of 12. And so the amortization of the discount should be $1,000. And so we have that. We have the interest payable of $30,000, and we have the amortization of the discount for those 10 months is $1,000, which means we need to record interest expense of $31,000. So before we record the redemption, we need to record the accrued interest, and this is how we do that. Where did you get the 2%? So let me go back real quick. So the first sentence says 49er Company issues $600,000 in 10-year annual bonds on January 1st, 2018, and it says at 98. So that 98 means that the bonds were issued at 98% of par. Since they were issued at 98% of par, that means the discount was 2% of par. So that's where the 2% came from, because the discount is 2% of the par value. All right, so this is step 1, record accrued interest. Step 2, record the redemption. So we know the cash payment at redemption is the call price plus contractual accrued interest. Again, they cannot forego interest by calling the bond early. And so the call price is 101% of $600,000, and we had already calculated the accrued interest as $30,000. And so in order to call this bond on October 31st, the company has to make a payment of $636,000. You have to remove any remaining discount balance. This is probably the one, if you're going to make a mistake on this kind of problem, this is probably where it's going to be made. And so the initial balance in the discount was 2% of par. Again, 2% of par is $12,000. The initial discount balance was $12,000. Through straight line amortization, we would have amortized $1,200 every year. So in 2018, they would have amortized $1,200, and then in 2019, they would have amortized another $1,200 for a total of $2,400. Then we had just recorded amortization of another $1,000 as part of the interest journal entry. And so that extra $1,000 there is also showed up. And so the $12,000 original balance would have been decreased by a total of $3,400 prior to the redemption, which means that the remaining balance in the discount is $8,600. And of course, a discount has a normal balance of a debit, and so in order to remove the discount, we need to credit that account $8,600. Again, this is probably the piece of the transaction or the calculation that most students would struggle with. Hopefully, through that explanation, you might need to rewatch it later, but hopefully through that explanation, you get where that number came from. Of course, we do also need to remove the bonds payable, and the par value of those bonds is $600,000, and that's going to be a debit, of course, because we're getting rid of a liability. And then finally, we do need to remove the interest payable from the previous entry. That's a $30,000 debit. And then there's going to be a gain or a loss, a gain or a loss. And of course, we do know that it's going to be a loss in this case, just from what I explained before. Okay, so taking all that information into account, the bonds payable is coming off our books. That's the par value of $600,000. The interest payable that we previously just accrued comes off our books. That's $30,000. We're getting rid of the discount balance. That's $8,600, and we calculated the cash payment as $636. And so the difference then is a loss on bond redemption, or loss on redemption would be fine, of $14,600. Again, that's one where some students get a little bit tripped up, but hopefully you're able to follow all of that. All right, last kind of idea here, some ratios we just need to go over very quickly. The debt to asset ratio, which is like a measure of solvency. The more solvent a company is, the better they're able to handle and service their debt. Less risky, less financial risk. And so the debt to asset ratio is total liabilities over total assets. And then the second ratio that we need to kind of focus on is the time interest earned ratio. This is a company's ability to cover its interest payments. And the way that we measure that, so the times interest earned ratio is our income before taxes and interest expense divided by the interest expense. And basically what that says is how many times over do we cover our interest expense with the income that's available to pay it. And so that's the income before taxes and interest expense over interest expense. Again, those are kind of two different measures that are important for long-term liabilities. Again, they're hopefully fairly easy to calculate. And that is it for now. Of course, before I go, I always want to leave time to answer any questions you might have from the lecture. This was probably more typical as far as the length of one of these lectures. So you can see we kind of went for nearly 2 hours. If the lecture were to go longer, let's say it was going to be more like 3 hours, I probably would break it up into two pieces. 2 hours I know is pushing it, but also I didn't want to do like 1 hour and then take a 30-minute break and then do another hour. I'm just like, I'll just kind of trudge through it. So, this is way different than doing it in person. I understand that. I definitely felt like I was droning on there for a while. I don't know, it's tough. But again, I hope that if there are areas where you got a little bit lost or weren't sure, that by going back through and reviewing the information, I hope you're able to learn it and understand it. hopefully your groups can also help you if you're in a group. And if you're not, or if your groups can't help you, obviously you can reach out to me. Like I said, this week, I'm not going to be able to have office hours on Thursday and Friday with the holiday weekend. We have a bunch of people in town. It's loud enough with 4 kids here. It would be absolutely crazy with a whole nother family here, which is what's going to happen. So I'm going to have, I think, 10 people in my household for the next few days. And so that would not be effective. But instead, in future weeks, I do plan on having office hours on Thursdays and Fridays. I haven't exactly figured out when or how much, but it'll probably depend on how much demand there is. But again, if there are any questions before we go, please let me know. Okay, everybody. I think that's all I got. I appreciate it. Oh, Ryan's got a question. Will there be anything outside of the lecture notes that will be on the test? Not really. I mean, I say not really. Here's how I create my tests. I look at my notes and I think, would this be a good question to ask them on a test? Or what would be a good way to ask this question on a test? So everything that I write comes out of the creation of my notes. I don't pull information like say, well, here's the exact same problem, put that on the test. Here's the exact same phrase, put it on the test. I don't do it that way, but as much as I create my notes, I create my tests out of the same thinking. I don't pull from a test bank. I don't use outside resources. I use my thinking to create my questions. And so yeah, there's nothing outside the notes that would be directly helpful. But again, I think doing the homework and studying the book or other resources, there's no way, it would be helpful, but the primary source should always be my lectures, for sure. Any other questions? No problem. All right, everybody. Thank you so much. And again, if I don't talk to you before then, do well on the test. Your groups are all set up. You should be able to start using that. No problem, Shane. Glad to help. And again, if you have any questions, feel free to send me an email, and we'll figure it out from there. Let's knock this first one out of the park. All right, take care, everybody.